This is the key which opens the door for future growth and stability.
That's the CEO of Lucid, a company you probably haven't heard of, even though it was valued at $24 billion last year.
And the key he's talking about is a SPAC, or a special purpose acquisition company.
From mid-2020 to 2021, SPACs were one of the hottest investments on Wall Street, making up the majority of US IPOs. But by May of 2021, activity had sharply declined. That month, there were about 125 fewer IPOs than there had been 3 months before.
It's really been stunning how quickly it's come to an end in the past year and a half.
So, what went wrong? A special purpose acquisition company, or SPAC, exists to merge with a private company and take it public. It's an alternative to a traditional IPO. Here's how they work. First, founders raise money from investors and set up a shell company, which they then take public with an IPO or initial public offering. That's the SPAC. Then, they search for a private company to merge with. But there's a deadline, usually 2 years. From here, there are 2 possibilities. If the SPAC doesn't find a company, it's liquidated, shareholders receive their money back, and founders lose the millions it took to set up the company. If the SPAC does find a target, they merge, taking that company public. The company replaces the SPAC in the stock market, and investors can now buy shares. But why would companies want to skip a traditional IPO?
You can make business projections, you can communicate to the public and do things that you normally can't in a traditional initial public offering.
The method gained popularity, and in December 2020 and January 2021, many SPACs were raising billions of dollars. They tapped into trendy businesses.
We're going to space, Richard.
Like electric vehicles, satellites, and flying taxis.
And they were very attractive to individual investors who looked out and said, I want to own the next Tesla. I want to find these startups that are going to make me a lot of money.
The buzz was also fueled by social media star founders who posted their accomplishments online.
So what would happen is a SPAC would announce a merger, and then creators like Chamath Palihapitiya or others would promote the merger on CNBC.
It's a business that I think will become extremely valuable.
They would tweet about it, and individual investors would jump on the bandwagon, and these things would start trending.
The hype helped fuel stock price gains for companies like Lucid, Virgin Galactic, and Nikola. And SPAC founders generated average returns of more than 8 times their investment in 2020.
There was a period in time that I tracked where every single company that announced a SPAC merger, shares of that SPAC went up.
But the flood of fundraising and IPOing didn't last. After a record month when SPACs raised $36 billion, things took a turn.
Even academics, journalists, people like me were writing articles saying, like, this won't end well because we have a lot of data showing this historically never ends well. But people weren't really listening in that moment, so it just became like a firestorm.
One of the 2 reasons behind the fall was that a few electric vehicle startups had promised success in their business projections, misleading their investors. Take Arrival, which sells electric buses. It said it would go from 0 revenue to $14 billion in just 3 years. Arrival's president explained the projections by saying that 2021 was a turning point for rapid adoption of electric vehicles.
In many cases, what was under the hood was not very pretty and not as bold and like spicy as people thought at the time of the merger announcement. So there was a lot of bad information, frankly, out there too that was pushing people to jump on the bandwagon.
This caught the eye of regulators and led to the second reason behind the fall. In April, the SEC warned that some SPACs might have to restate their financial results.
Because at the end of the day, we need to ensure that investors are protected.
Both reasons spooked investors. Share prices declined, and many investors withdrew their money rather than hold on to shares of startups after they completed SPAC deals. After the summer of 2021, companies started to think twice before going public with a SPAC.
A lot of companies are really second-guessing whether they want to do SPAC deals as well. So that kind of positive effect that made SPACs boom is now working in reverse, where now the negative connotation is making everyone second-guess things.
Activity stayed at a relatively low, consistent rate for the next year. Then, in March 2022, the SEC proposed a set of regulations that would make it harder for SPACs to raise money from investors and execute mergers.
I've asked staff for recommendations about how we might update our rules so that investors are better informed about the fees, the costs, the conflicts that may exist with these SPACs.
The goal of the regulations? To make companies disclose information more like a traditional IPO.
But a lot of the damage had already been done by that point. That sentiment, though, that regulators are stepping in and going to regulate these things more, that's also had a chilling effect for sure in the SPAC market.
By May, about 90% of SPACs that merged during the 2020 boom were trading below their initial listing price. Analysts estimate that if the current pace of mergers continues, a large percentage of the roughly 280 SPACs that have deadlines in the first quarter of 2023 won't find a match. Recently, SPAC activity is at a low.
SPAC activity is basically drawn to a standstill. In July, no new SPACs raised money. Early last year, there were basically tens of new SPACs every week. The market, along with the broader stock market and market for newly public companies, has definitely reversed a lot.
After interest rates climbed in the spring, speculative investments are losing favor, and valuations for companies that went public through SPACs may continue to come down from the highs of 2021.